Welcome to ING's Think Aloud, where we try to make sense of the world in the most unbanky way we can. In today's episode,
this legislation breaks international law, but it also breaks domestic law. The Prime Minister and his friends, a parcel of rogues, are creating a rogue state, one where the rule of law does not apply.
Ian Blackford of the Scottish National Party slamming the UK government for changing some of the provisions in Britain's divorce agreements with the EU. Prime Minister Boris Johnson says the government is merely clarifying specific elements of the deal, protecting jobs and growth. But the government does admit that the new bill breaks international law in a limited and specific way, a move which has put strain on already tense relations with the EU and is threatening to undermine a trade deal. Financial markets are getting worried with the pound falling to a 6-week low against the dollar. But what does it really mean for the British economy? I'm Rebecca Byrne, and today I'm joined by ING's developed markets economist James Smith to find out. James, first of all, what on earth is going on? Please explain it to us.
Yeah, it's all a bit of a mess. Essentially, all of this comes back to this issue of state aid. So the UK government's decided it wants this power to support British industry once the transition period's ended through subsidies or other forms of aid. And the EU is saying, well, if you want a free trade agreement with us with no tariffs, then we need some concrete reassurances. You're not going to abuse these state aid powers in a way that might put European firms at a competitive disadvantage. So that's the centre of all of this. The issue the UK government's got is the deal it signed last year, the withdrawal agreement. It obliges the UK to follow state aid rules from the EU, where the intervention they're making might affect trade between Northern Ireland and the EU. And that's potentially far-reaching. So the government might want to subsidise a company operating in England, but if it sells that product in Northern Ireland, then it might need to loop in Brussels into the process. And this is proving to be a source of quite a lot of annoyance in Westminster. So what this bill, the internal markets bill that the government's published this week, basically seeks to do is effectively override parts of what was agreed last year on state aid and a few other bits and pieces. And this is causing a real stir because, in effect, what the government is saying is it's going to disregard international law.
But is this just all sabre rattling? Is this just a negotiating tactic?
Well, the bill is undoubtedly bold and actually perhaps is even more incendiary than reports earlier in the week said it might be. And actually, ministers have made no secret of the fact that it would potentially break international law. The interesting thing is that because it's so bold, a number of people are saying, well, this simply won't get through the House of Lords. And you could argue, well, if the government is, set on overriding the withdrawal agreement next year, why are they sort of effectively telling everybody about it 4 months before the end of the transition? And I think that's kind of bringing back some memories of last year when you might remember the government decided to prorogue Parliament, a decision that was later ruled to be unlawful. And there's a bit of sense back then and maybe again now, this process is designed to inject a sense of pressure, a sense of crisis maybe into negotiations to try and engender some movement from the EU.
So what are the odds that we're going to get a deal at this point? I'm presuming they've gone down a bit.
Yeah, I think it's fair to say that. To be honest, having said everything I've just said, I think it is really 50-50. The problem is that this latest move will remove any remaining trust there was in negotiations. And the EU will be very wary of signing a new free trade agreement with the UK if there's any possibility of it reneging on that withdrawal agreement it signed last year. And actually, going back to that comparison I made with what happened last year, obviously we had all the fireworks, but a deal still miraculously appeared. Well, back then, the important thing to remember is the compromise Johnson did effectively guaranteed a more arm's length future relationship with the EU, arguably one that he was much more comfortable with than Theresa May's deal. This time, and the big difference is that if there's going to be a compromise on a deal, it's going to involve ceding power on state aid, and we know the government really doesn't want to do that. So I think it's also fair to say as well, actually, that while the government is probably more open to getting a deal than this week's shenanigans might suggest, I don't think it will do one at any price. We know this government doesn't believe no deal will be a disaster. So I think, as I said earlier, 50-50.
Since the referendum, James, in 2016, there's been a lot of talk about the need to avoid a cliff edge. But you would say that actually, whether or not we get a deal, it's not going to make that much difference to the economy. Tell us why.
Well, I think what I would say is that compared to the current state of play, where the UK is still pretty much aligned to the single market and customs union, even with a free trade agreement, the new trade terms will be a long way from what we're all used to. It's going to mean a lot of new costs for businesses. There's a couple of things to bear in mind. I mean, firstly, it's going to affect some sectors who so far have been less affected by the pandemic. So agriculture is a good example of that. There's no trade deal, then the industry faces steep tariffs, and these goods are often the most heavily scrutinized at border checks as well. But where it does affect industries already hit hard by COVID, it's going to hit them in different ways. So car production, for example, has been really hit hard so far, and any disruption at the borders next year would seriously impact upon their just-in-time delivery systems, really raise costs. So how do you deal with that? Well, you could raise stockpiles, but clearly that's going to be expensive, and many firms, particularly smaller firms, won't have the financial resources at the moment. Now, having said all of that, if there is a free trade agreement, it would help things a little. It would mean no tariffs, which is good. It would also potentially allow some agreement to keep trade flowing in different ways. So, for example, both sides could say, well, we'll limit checks on animal products, for example, to only a very small percentage of the goods that actually come through, and that would take a bit of pressure off. So it's that kind of thing. So a deal is still better than no deal, but in either scenario, there's going to be a lot more form filling, there's going to be some disruption, and that expense is going to put the brakes on the overall COVID recovery.
Right. Well, at the start of the COVID crisis, we saw empty shelves in the supermarkets. There was loads of stockpiling going on, sort of apocalyptic stuff, really. But that's calmed down a bit now. Is there a chance we go back to that, though, and see this sort of crazy panic buying as the Brexit deadline approaches?
Yeah, so I think the economic effect of when the transition period ends is going to be quite different to what we saw with COVID-19. It's hard to see a really sharp and sudden drop in consumer spending in the new year. And actually, if you look back to what happened in 2019, surprisingly, when we had those original no deal deadlines, consumers were pretty unfazed. Now, it could be a bit different this time. Perhaps we see a bit more stockpiling going on. You know, we've seen it with the toilet roll debacle earlier in the year, but most likely we won't see a big change in consumer spending straight away next year. And therefore, we probably won't see a huge impact on GDP either straight away, at least in the same way COVID-19 struck. The difference is the way the change in trade terms will impact is initially smaller, but clearly much more long lasting than the way the pandemic has hit the economy. It's going to be much more permanent in the way the changes are for businesses.
Mm. Well, social distancing rules have just been tightened again in the UK, as you know, although the government is, of course, still encouraging everyone to go back to the office. Will this affect growth in the second half of the year and the outlook for next year?
Well, the first thing to say here is we're going to see a big growth number in the third quarter, potentially around 17%. Now, of course, all that really tells us is that most sectors were reopened in the third quarter, whereas a lot of them were shut for most all of the second. And from this point on, the recovery is likely to stall. We're unfortunately likely to see unemployment rise through the remainder of this year, potentially to around the 9% mark. But a lot, as you say, depends on the spread of the virus. I think at the moment, the real focus of the government, and we're seeing this in Europe as well, is really on limiting private gatherings where they can, as opposed to closing parts of the economy again. That's clearly going to be the priority, I think, over the winter. But one of the other things to remember, of course, is what happens with the vaccine. And even if there is a successful vaccine developed, it's presumably going to take quite a while to get rolled out to the population. And that, in all likelihood, means social distancing is going to be with us in one form or of another. At least for another year or so, I suspect. So the upshot is UK GDP, the recovery, is unlikely to get back to where we were pre-virus until maybe the end of 2022 or later.
That's quite depressing. Does it make it more likely that the Bank of England starts looking at negative interest rates?
Well, it's interesting. I mean, despite all the hype surrounding negative interest rates in the market, all the commentary coming from the bank over recent weeks tells us that they actually think quantitative easing is a much more important marginal policy tool, i.e. the best way of fine-tuning their stance. So we think we are going to get more stimulus later in the year, and that probably will involve some more QE. On negative rates, though, I think, well, we've had the bank formally say it's in their toolkit. I think it's fair to say they're still on the fence on whether this is actually a good idea or not, whether it's much use. The message at the moment seems to be that it all depends on the situation in the banking sector, how willing banks are to lend through the next phase of the crisis. So we'll see. What policymakers might do as a first step, perhaps in November, is to lower the interest rate on what's called the term funding scheme. This gives banks access to cheap funding if they increase their lending to SMEs. So that would possibly be the interim step.
In terms of the financial markets, we've seen some weakening in the pound over the past week or so. Investors obviously seem to be getting a bit nervous. Is it still vulnerable at these levels?
I think the simple answer is yes. I mean, when we talk to our colleagues in our FX team, when they look at this, they look at how much risk premium there is in the pound. And this time last year, or even back earlier in the year, we'd seen about 5% risk premium in euro sterling, but now it's maybe 1%. And we also know if you look at speculative positions, so how investors are positioned, they're not particularly short the pound at the moment. So there is scope for that to change. So the message is from our FX colleagues, when you put that together, when you consider all the noise we're likely to get in negotiations, there is scope for the pound to weaken from here. In fact, if no deal becomes, the real base case, if it looks like it's going to happen, then we could easily see euro sterling trade up to its current highs for this year of about 0.95.
We've got a budget coming up in autumn. What sorts of measures do you think Rishi Sunak is going to come out with? Could there be more help for the unemployed, some extension to the furlough schemes maybe? What do you think? What are you expecting?
Well, I think unlike in Europe, it's unlikely now that the government's going to extend its furlough scheme. And the rationale is that the longer the schemes run, the more likely it is you're protecting jobs that are unlikely ever to return after this pandemic, maybe because of structural shifts. So the view in the Treasury is that it would be better to end the scheme and try and encourage a reallocation of these dislocated workers into other sectors or other jobs. I think the challenge with all of this is that there's a number of areas, particularly in hospitality, that are still effectively closed because of government guidelines. Think conference providers, events, theatres, all that kind of stuff. And all of these things will probably eventually come back when all of this is over. And in fact, may be able to gradually come back over the next few months if the government can make good on its target to get mass testing underway later in the year. But before all of that comes, I think more support is going to be needed. We might not get a targeted job retention scheme extension, more furloughing, but there's going to have to be something, I think, for these sectors. The other thing, I think, is we're going to have to see the furlough scheme switch probably to putting more emphasis on sort of creating jobs, facilitating jobs. So I guess what we might see is sort of wage subsidies for firms that take on previously furloughed staff, that kind of thing. But I think whichever way you look at it at the moment, unfortunately, it looks like we are going to see unemployment rise this winter, and that is going to put brakes on the recovery.
Okay, James Smith, ING's Developed Markets Economist. Thanks very much.
Thanks a lot.
This podcast has been prepared by ING solely for information purposes, irrespective of a particular user's means, financial situation, or investment objective. The information does not constitute investment recommendation, nor is it investment, legal, or tax advice, or an offer or solicitation to purchase or sell any financial instrument. Read more at think.ing.com/content-disclaimer.